You got it?
I do.
Yeah, you do have it. Welcome to Weekly Sense, everybody. It is Wednesday the 15th. We're going to do it a little bit early because it was a big day in not only the markets, but also from news from the Federal Reserve. But before we jump into that, Carl, I kind of wanted to pull up a chart of the S&P 500 just year to date to kind of show, what we've been through here. So, Carl, you want to kind of explain what this chart's looking at and what we're seeing here?
So this is the S&P 500 over the last 3 years, it looks like. And then we've got the 50-day and 200-day moving averages on there. And a lot of people watch those because, well, traders watch those a lot for different levels of support and resistance. And as long as the market is above those key moving averages, then people feel like, oh, we're definitely in a bull market,
Right.
or we're not. And you can see, if you look really carefully, a lot of the action and pullbacks have kind of stopped or maybe gone a little bit beyond the 50-day moving average, but not that much. In fact, the market has followed that really well. And then when you get into like a deeper pullback or so, you can kind of test the 200-day moving average. And then when we got the first significant wave down in January in this correction, now some would say it's a bear market because it got below 20% on Monday. When you see that break of the 200-day moving average there, a lot of people would say that's a change in the trend, and so the sentiment really starts to change.
My big thing about this, why I wanted to show this to everybody, is that emotions have a big role to play in directions of markets, right? Both to the upside as well as to the downside. And, we don't know if we're in a recession now. We don't know if we're going to go into a recession. We don't know if the Fed's going to be able to, slow demand down enough to control inflation. But the market is already projecting and reacting like we are in a recession. And why I wanted to bring this up is because we looked at charts in the 1970s and in the 1980s of both CPI inflation numbers, the S&P 500 at that time, as well as what the Fed did. And what we did notice was, as the Fed started to combat inflation, you saw extended amounts of volatility. But every time prior to the actual recession taking place, you experienced a uptick in the S&P 500 prior to the recession. Now, we did notice that throughout history, there had been a few times where you had a bear market outside of a recession, but none of those bear markets outside of a recession happened during an inflationary period of time. So that's just something that I wanted to point out was, with the market reacting as difficult as it has this year, it's assuming a lot of things. And, we saw the Fed come out today, and we'll talk about that a little bit later. But I just wanted to kind of show, the carnage that happened so far this year in just the S&P 500, essentially wiping out all of the gains from last year.
Right. So it's possible that we're in a bear market here, even though we're not in a recession yet.
Right.
The reason all of that's significant is because historically, typically markets peak when, the equity market peaks when you're just entering into a recession.
Right. And this next one that we wanted to bring up was earnings forecast. Why don't you walk us through the importance of this chart, and then I'll kind of add some points to it.
Well, the overarching theme is that prices of stocks follow earnings. So when earnings go up, stock prices should go up. And when they go down, when earnings go down, stock prices go down. And you can see that the level of the S&P 500 is tracked. The line of earnings there, and I think that's probably like a line of 16 times earnings or so, the average.
Yeah, the blue line is forward earnings for the entire S&P 500. So a conglomerate of analysts kind of look at the overall aggregate of what earnings are expected to be for the S&P 500. That is that blue line.
Right.
The white line,
it's overlaid.
Yeah, the white line is the S&P 500.
Right. So it follows typical multiple, but there are notable times where there's divergence. And, sometimes it's during a recession, sometimes it's during a big correction, but there have been notable periods, and we're in one right now. And so the key thing is, are earnings going to roll over with the market, or is the market going to bounce back up? If earnings continue to grow, or they don't decline much.
Yeah, I mean, what's interesting here is every time you've seen this decoupling, right? So this is back in 2011 where you had huge decouplings. Sure, earnings came down slightly, but eventually the market started to catch up to what those earnings expectations were. Again, here in 2018, where you had a slight dip in earnings projected of what they were going to be for the following year, you had that rollover very similar to what you're kind of seeing right now. And to your point, are you going to see earnings completely collapse, or is the market going to realize that maybe the Fed has this under control and it could maybe put a bottom in and start to find a way to, get closer to a trend that's closer to actual earnings, right? That's kind of what we're saying here.
Right. I mean, I think there's a small chance that, there's probably a 20 to 30% chance that, they can lower inflation, and there will be other things that have to happen on that front over the next 6 months plus.
Right.
But probably not. We probably need to be in a recession in order to stop this amount of inflation. That's been history, because we haven't had this amount of inflation since, the 1970s and 80s. But based on all the indicators we watch right now, we're not in a recession yet. So, I mean, I expect the most likely path is that things will bounce around, and maybe we could have a bounce back up to where the S&P is at 4,400 or so sometime near the end of the year or next spring. That's kind of the behavior that we saw when we looked at how the market behaved
in the two recessions
going into the recessions in the 1970s.
Yeah. And even in the 1980s, it reacted almost the exact same way. A key difference that we've discussed, and you even just put out in Carl's desk, was the fact that in those previous two bouts with inflation, the Fed actually had to raise the federal funds rate above the CPI. So in the 1970s, they raised it to 8 or 9%. In the 1980s, they raised it to 15%. With CPI being at 14 or 15%. So if history is any indicator, that would tell us that the Fed needs to raise the federal funds rate to 7 or 8%. If this inflation is as sticky or is the same as what it was in the 1970s and 1980s. And what you and I keep going back to is, how are they going to do that?
Right. We've done a lot of work on that, and looking at debt levels and the amount of pressure that would put on the housing market, and then the federal government's interest expense. And I don't think they can get there. It makes sense that you should have the federal funds rate above the CPI, and that you should have, most of the time, you should have positive real interest rates. You should have an interest rate that's higher than inflation. If you don't, it's a problem, and it actually incentivizes people to borrow.
Yeah.
What's different here is the amount of quantitative easing that's been done, and how much debt is out there, not just in the government, but in the private sector. We've been on very low interest rates the last 10 years. So I'm based on how everything has behaved when the in the business cycle ending, when yield curve gets flat or inverted for a particular period of time, I'm sure that we'll be in a recession shortly after they get the Fed funds rate up around 3.5 or above.
Yeah.
And then once we're there, they can do whatever they want. They can raise it more. But after maybe 6 months to a year, once you get there, then, once unemployment is going up, there will be inflation declining. It's just a matter of what rate. And then how quickly do they get easy and, cut the Fed funds rate or get in quantitative easing mode?
Well,
they don't have to do that. They don't have to do that quickly. They could stay there for some time until the inflation is down low enough, back to 2%. It's just, how long do you have to have a recession go on to get there?
Yeah, I wouldn't expect a quick pivot because they are in a pickle to lower inflation to at least something manageable. And the value professor from NYU was talking about maybe we just have to live with a new standard of inflation of 3 or 4% over the next decade, which is going to change asset models, which is going to change discount cash flow models, which is going to change business valuations. Because over the last 10 years or 12 years, a little longer than 12 years now, we've been living in a sub 2% inflationary environment, which has caused a lot of expansion and risky assets. And we're starting to see the detriment of those consequences right now. So we want to get to the biggest piece of news today, and that was the Federal Reserve. So we've been calling and saying they should be a little bit more aggressive, kind of get out in front of it, get some of the pain out ahead of time. And I think a lot of the volatility that we've been experiencing has to do with the uncertainty of, is the Fed going to even take inflation seriously? Because they haven't for the last 12 months. And I think they made a pretty clear statement today. You know, they raised rates by 75 basis points. I was hoping that they would come out with a full 1% and just, you know, try and swing for a home run. But 75 basis points is at least a step in the right direction of confirming to the market, or at least affirming with the market, that they are going to try and do what's necessary to combat the rise in inflation, specifically because in May, we actually saw inflation go up. So the narrative of peak inflation was completely obliterated. I mean, it wasn't, you know, up much, but it still was extremely elevated. And now the Fed, what I took away from the meeting and the press conference was that they are very data dependent. Where the market was before like, hey, tell us the clear direction, tell us exactly what you're going to do. And now they're saying, hey, if we have to do 75 basis points because inflation isn't coming out, if we have to do more in the future, it takes time for these rate hikes to cycle through the economy. And I think you and I looked at a chart today where on average, it takes about 6 months for the economy to really feel the effects of higher rates, at least on the federal funds rate. So 6 months from now is a really long time, to what Jerome Powell said today, that inflationary numbers, conflicts even, can be completely different by the end of this year. And maybe they can, you know, not have to aggressively, you know, stay at 75 basis points throughout the end of the year. And
right. So they showed some guts today on that.
yeah, it was great.
But what stood out to me was that he said several times that they want to get inflation back down to 2%.
Right.
So,
and look, he's trying to do a softish landing. But right now what this chart looks at is basically they're pricing in 200 basis points over the next 3 meetings. So what is it at today, Carl? Is it 175?
no, it's 150 to 175.
So, okay. That would be 250 to 275 by the end of the year, or 350 to 375 is what the market's pricing in.
Yeah. I could check that on another site here. Maybe it's changed, but in any case, it's a lot. It's something like that by the end of the year. And that's what's been the source of all this volatility this year. I mean, when we started the year, there was only expectations for maybe 3 or 4 25 basis point rate hikes. And by the time we got to March, we were talking about 7.
Yeah.
Now we're actually doing like bigger, like double and triple rate hikes.
Well, I think that's what the market really wants, right? I mean, I think the market and the market participants are afraid of what happened in the 1970s and the 1980s reliving itself. And at least the Fed is taking a stance of saying, hey, we're coming out, right? And I know last meeting, they took the 75 basis points off the table, but it means a lot to be able to pivot and say, hey, we're going to put that back on because inflation is not coming down at the pace of which we want it to come down. And yes, it's going to affect the labor market eventually. But what he did say today was that there are going to be some unintended consequences from these higher rates, and most likely on the private sector. But you know, the Fed's got a big job ahead of them. And this next chart that I wanted to bring up is basically what the G7 is expecting inflation to look like for the rest of this year. So what this chart looks at, and I'll kind of zoom in a little bit more, this looks at all of the G7 countries: Canada, Germany, France, United Kingdom, Italy, Japan, and the United States. So the United States is in orange. And what this is looking at is what they expect inflation to be by the end of the year and into 2023. So if you kind of roll this chart, they're expecting inflation to peak sometime in this second quarter, which is, over the next, 60 days or so. And by the end of the year, be somewhere closer to around 6%. So even if we have the federal funds rate at 3 or 3.5 by the end of the year, it's still not going to be enough to really cover that inflation expectation of what happened in the 1970s when they went above it. But by next year, they're expecting inflation to be down into the 3s and even to the 2s by the end of the third quarter of next year. But a lot of things have to happen, not just in the supply chain, not just in what's going on with Russia and Ukraine, but a major component is going to be oil.
Right, oil too, because producers have been slow to increase production in the wake of the COVID shock there, where oil was briefly negative and really stayed low for a whole year. So, we've only seen really a quarter since the war started. And so that's not really enough time for them to adjust. The rig, we looked, the rig count is going up and it probably will continue to climb. And it's quite possible that by the end of the year, there could be a lot more oil production going on in other places and oil could be on its way down. And it looks like the energy sector, the way it's trading is starting to price that in right now.
Yeah.
But also a key thing about everything that's happened is that now that rates, particularly longer term bond yields, have gone up a bit, and the Fed has to do more hikes, in my view, it extends the business cycle a touch because, you could have, I don't think we're in a recession yet right now based on all the indicators that we're looking at, but, they're going to have to raise the Fed funds rate. And I'm looking at the CME Group FedWatch tool right now. So what's priced in is now that they actually did a 75 basis point hike, like before today, the market was only expecting one sometime over the next few meetings, but now another one is expected in July. And then in September, we have a 50 basis point hike, and that would get us to 275.
And then maybe another 50 at the end of the year.
3. And then in November, sometime in here, there's another, 50s are expected. And in December, the most likely expected Fed funds rate is 350 to 375.
Yeah. Well, look, if inflation can come down to around 6, and they can get the federal funds rate up to, almost 4%, I think that's a huge step in the right direction. But, to talk about oil, because, we looked at the components of the CPI index, and just a fun fact for everybody out there, all the men that are out there listening, suit wear has gone up 22% year over year. So the cost of a suit. And I said that to Carl, and you told me, hey, it's not just because they're suits, it's because of all the components that go into making a suit, as well as the transportation component.
There's a little more labor in suit making and haberdashery than in most things.
And why oil is so important is because it's a component that transports goods. It's not so much the input costs have increased by that large amount, but just to even transport things and the logistics of that have increased, 50% or 100% over the last year as far as the input price of fuel costs of transportation. But what I thought was really interesting is this chart right here. Let me pull this up. So this is basically the forward expectations or the forward curve, which is in green. Let's just focus on this left quadrant chart right here, and the actual forecast of what the analysts are expecting oil prices to be. So the forward curves are putting, oil somewhere around $107 a barrel by the end of the year, but the actual forecasts are coming in below 100. And why I wanted to point that out is because it's great to forecast all these things, but it's equally as important to show where people are placing their bets, right? Where are they putting their hard-earned money to bet on these things? So if we look out to December of 2022, the end of this year, there's more calls. You can see calls to the upside, betting that it's going to be higher, 524, than puts to the downside, 361. But if you look at the clusters, there's far more larger aggregation of clusters to the downside below $100 a barrel than there are to the upside, except for this one that's betting that oil is going to be 150 by the end of this year. So money's actually coming in betting that it's going to be below $100 a barrel. And the forecasters are expecting oil to be below $100 a barrel. If that happens, that's going to provide at least a short-term reprieve to the acceleration that we've been seeing in the CPI index.
Right. And the reason oil and gas are so important is because it's not just moving things around, the transportation component of which applies to just about everything, but it's also in the raw materials for things. Like when you think about all the inputs to agricultural commodities, like it's not just moving the plants around and processing them, but it's also making all the fertilizer.
Yeah.
So even though, we were just discussing how like, what can the world do to get away from fossil fuels? Well, in agriculture, there's no real good way, because you need, with the amount of people in the world and the amount of food that we have to grow, you need to be able to make nitrogen-based fertilizers, and you need natural gas to do that.
Sure.
So, even when you talk about the suit, it's not just moving it around, but it's like feeding the sheep to grow the wool.
Right.
And then, aside from the labor, and the labor is affected by energy prices too, because, people have to eat more and move around, and that all costs more. So, energy just affects so many things. So that's why having oil prices double in a matter of 6 months just really is, it's a significant shock.
Yeah. Well, before I let you go, Carl, I wanted to address the elephant in the room, and that was cryptocurrencies. So I know we didn't have this on the agenda to talk about, but it's hard to have weekly sense without talking about the absolute demolishment of crypto, just even in the last week, not speaking year to date. I think Bitcoin's off 60%. I think Ethereum's off 70%. NFT market is completely collapsed. And I wanted to just hear from you, your thoughts in those areas. Obviously, we've seen some of the custodians, close withdrawals, and we've actually even seen some of the stable coins blow up. Just any thoughts on cryptocurrency and how it relates to kind of that first chart that we brought up, which is, volatility in the market.
Right. Well, even I don't think cryptocurrencies are dead. I think there will be some good things that come out of it and stick around. It's just everything that isn't that good or has problems is maybe in the process of getting flushed out. So
Right.
just how there are certain coins and companies that are designed around giving people a yield by, well, maybe as much as 20% by lending out an underlying cryptocurrency, and then it collapsing like in a run on the bank kind of fashion. That's kind of surprising. I'm not too familiar with the details of how those things worked, but one of those happened in May, which led to a lot of the volatility in mid-May, and then another one happened last weekend, which led to more volatility this week.
Yeah.
A lot of people thought maybe it was just anticipation of what was going to happen with the Fed, but I think the amount of money that is in cryptocurrencies and potential wealth getting destroyed over there, it seems like it could be significant enough. Maybe it could be on the scale of, the amount of bad loans that were made in 2007 and prior. So
I can promise you
there's
going to be not only a demolishment in the price of the currencies itself, but also the wealth effect that it's created over the last decade. And the individuals and anybody that's listening needs to take a note from what's happening right now in cryptocurrencies to focus on risk before you focus on the dream of return. And this is a perfect example of by not understanding the risk or limitations. You read the stories of people taking out mortgages to purchase these things. You saw Michael Saylor, which is the CEO of MicroStrategy, saying lever everything you can to purchase this asset. And I think that's when it was at 60,000. Today it's at roughly 20. So real people can get hurt just from undereducation in these kinds of things. But I did want to point out, there was something called Luna, which was supposed to be a stable coin. And it collapsed to zero in a matter of a week. And when Bernard Madoff, who is the individual responsible for the largest Ponzi scheme in the United States of America history, in 2008, when his securities firm collapsed, that was $60 billion. And he served, I think, he was sentenced to about 120 years in prison. The founder of Luna, which collapsed, and that was 60 billion as well, went to zero. He just started Luna 2.0. So that just goes to show you how much this industry has actually grown, that specific space, to maybe only make CNBC News for one day. And that was $60 billion, the same amount. So people need to focus on the risk before they focus on the dreams of the returns with any kind of investments, but specifically the ones that have a high degree of volatility like cryptocurrencies. So who knows where it's going to go? Obviously, there's some inherent types of use cases. I feel bad for the country of El Salvador because they converted it into legal tender and they started purchasing it at roughly 40,000. So it'll be interesting to see how that all pans out.
It's a speculative asset class. The founders, the creators of cryptocurrencies are not legally required to be fiduciaries or advisors.
Exactly.
Not necessarily on your side.
Right.
So that's what's going on there. I mean, I know there have been others in the past where people created them and they were just, people lost money and it was completely fraudulent, right?
Yeah, it's called a rug pull in the industry. Yeah, a rug pull. So, okay, Fed raises rates 75 basis points. Hopefully they stay on course and take inflation a little bit more seriously. What we've seen from previous recessions in the 1970s and 1980s is that the bear markets didn't lead to a recession. You had a bear market during or after the recession or during the recession. So there are odds of, seeing bounces prior to the end of the year. We've got the midterm elections coming up. That usually gives consumers a little bit more confidence if it goes one way or the other. And, we need to see oil prices come down pretty drastically in order to, slow down the acceleration of inflation. And the only thing the Fed can do is destroy demand. They have no tools to fix the supply chain. So that's it, Carl. Anything else you'd like to add?
Well, that's a good outline of everything that we expect to be happening over the next 6 months to a year. I would say that, yeah, there's a small chance that, oil production could ramp up and inflation could decline and the business cycle could get extended. We don't really expect that, but we expect things to be that we're early enough, far enough away from a recession at this point that I think things could be probably not get much worse from now, probably go sideways and probably, bounce sometime over the next 6 to 8 months. Although, we will be watching second quarter earnings really closely, starting about a month from now. It's not clear how good or not that will be. So we're just really watching everything very closely.
Yeah, and I do want to tee up Making Sense of Wealth. So at the end of this month, or maybe the first week of July, we've got a special guest. He's the head of economics at UNLV. He's a professor that actually wrote a number of papers on inflation persistency. So we're going to be bringing him on the podcast at the end of this month or the first week of July and asking him what he thinks about inflation, how sticky it is, how long it can last, or how persistent it is. So we're looking forward to everybody catching that new episode. But this is Weekly Sense, Carl. I appreciate it. Thank you.
Thank you, Andrew.
All right. Talk to you soon.
All opinions expressed by Andrew Whalen, employees at Whalen Financial, or any other podcast guest are solely their own opinions and do not reflect the opinion of Whalen Financial. Whalen Financial is a registered investment advisor. This podcast is for information purposes only and should not be relied upon for investment decisions. Clients of Wayland Financial may maintain positions in the securities discussed in this podcast.